Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at strategy class A.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. I've been looking over strategy's operational foundation, and, well, the first metrics you see suggest a company with just almost unbelievable fundamental strength.
Okay, but we have to address the elephant in the room right out of the gate, don't we?
You do.
And that is the profit margin.
Yeah.
Because you look at the financials, and the gross margin is great. I mean, 70%, that's fantastic operational control.
Totally normal. Very strong.
But then you see the profit margin.
Yeah.
Soaring at, 1,667%. That number just isn't believable for a software company. So what is that? Is it a data error, or is there some massive one-off gain just blowing up the numbers?
That is the crucial question. And yeah, it speaks to their, let's say, unique business model. That number is not from selling software licenses. It's almost certainly inflated by huge non-operating income.
So mark-to-market gains on their other assets.
Exactly. Their digital asset holdings. You really have to factor that out when you're trying to assess the sustainable year-over-year operational business.
That's a huge caveat for anyone looking at this. So, okay, if we strip out those unrealized gains and just focus on the core business, what does shine through?
The operational efficiency is still exceptional. I mean, look at revenue per employee. They're generating nearly $310,000 for every single employee.
Wow.
That shows an incredibly lean structure,
Right.
It shows real business sustainability. They don't need huge teams to pull in significant income. And that kind of metric, well, it implies they have a real competitive moat. Their costs are just so low.
Right? That's real tangible efficiency. Okay, so moving from that to how the market is actually valuing them, we see some interesting contradictions. The company seems to be trading really close to its hard asset value. The price-to-book ratio is just 1.02.
Precisely. The market is basically saying the company is worth its assets, which is fair. But then you look at future earnings potential, and the whole picture just shifts. The forward PE is surprisingly low. It's at 6.70.
Which suggests the market is, significantly discounting their ability to grow earnings?
It seems so,
Yeah.
which is strange, right? You have this great asset coverage, but the forward earnings are being sold short. Even though their return on equity, the ROE, is strong at over 25%.
Yeah, and an ROE that high usually signals accelerating earnings growth is coming.
I think it's the complexity of the balance sheet and, the volatility of their digital holdings. Investors are kind of treating strategy like two separate companies.
A stable tech firm and a volatile crypto fund.
Exactly, but their capital allocation is still excellent. Return on invested capital is at 18.46%. They are good stewards of their cash.
But that great ROIC number is about to be challenged, isn't it? I mean, it was calculated before they introduced a massive new cost of capital into the business.
Absolutely. And that, I think, leads us perfectly into the technical picture, which seems a lot more unified than the fundamentals.
Okay, let's unpack those technicals. Despite all that volatility we just talked about, the long-term trend is, it's rock solid. The stock has held above $175 since the second quarter of 2025. That shows some real institutional confidence.
The charts confirm it. You're seeing a clear pattern of higher lows, and the stock is trading comfortably above both its 50-day and its 200-day moving averages. So technically, it is in a confirmed bull trend.
So as of late October, the price was hovering right around $289. If that momentum holds and it breaks that 290 psychological zone, what are the next key resistance areas we should be watching?
We see two major levels. The first bit of friction is probably going to be around the $425 mark. But for a really high-end bull case, fueled by them using this new capital well, some analysts see targets going all the way up to 705.
Wow.
And here's a little technical nugget for people looking for an entry point. Short-term momentum indicators suggest it might be nearing a cycle bottom. The stochastic RSI is really low, like around 2.95.
Which often signals a stock is oversold and could be setting up for a pretty sharp reversal to the upside.
Potentially, yeah. An attractive entry point right before some big catalysts are expected to hit.
And that makes sense. I mean, the analyst consensus across the street is pointing to roughly a 75% upside from recent levels, which backs up those higher price targets.
Now, let's move beyond the data on the page, because the last few months have been defined by two huge sort of synchronized events. We're talking executive transition and a major capital restructuring.
Let's start with the leadership. In mid-November, the EVP and General Counsel, he exercised and sold a total of 5,200 shares, right around that $200 level.
And they cited a planned retirement, and it was under a 10b5-1 trading plan, so it was all scheduled out.
Right, which provides legal cover, but
But selling that many shares right before a massive capital raise sends a, let's say, a nervous signal to the market. It sort of suggests management might be cashing out a bit before navigating what could be a pretty rough transition.
and that exit perfectly overlaps with the bigger event, which was the massive preferred stock offering. They raised approximately 620 million euros in gross proceeds.
Yes, by issuing 7.5 million shares of a 10% Series A perpetual preferred stock. And the ticker on that is STRE. This is critical. You have to analyze the cost of that capital.
This is not free money.
Not at all. That 10% dividend is a high coupon rate. It gives them $620 million in cash right now, but it creates a huge ongoing payment commitment.
So that 10% is basically the new floor for their cost of capital. In a liquidation, those preferred shareholders get paid before the common shareholders, which increases the risk for existing equity holders, right?
That's the trade-off, exactly. You get instant funding for growth, but you introduce a senior class of equity holders who have first dibs on dividends and assets. The success of this move hinges entirely on management's ability to deploy that money into things that yield way more than 10%.
If they can't, the common shareholder gets burned.
Precisely.
Okay, so a huge capital injection, major leadership changes. This takes us right to the upcoming catalysts, and they are packed into the next 3 months. December 31st is a really crucial date.
It is, for two interconnected events. First, the General Counsel's retirement is official, which means we're going to see those strategic leadership changes we anticipate. And second, the first quarterly dividend on those new SDRE preferred shares is due.
And that first dividend payment is key. It sets the institutional yield expectation. If they pay it smoothly, it validates the new structure, attracts more institutional money.
But if there's any hesitation,
It sends a ripple of doubt through the whole company. Then we pivot into January, earnings season. The Q3 release on January 15th is going to be the first real look into how that offering is impacting their cash flow.
and crucially, how the executive transition has affected their guidance for the future.
And we can't forget about the institutional moves in late January and early February. ETF rebalancing filing deadlines are coming up.
Correct. Because the capital raise was so big, major index funds will be forced to adjust their portfolios and file those changes publicly. That action itself could drive a lot of volatility as funds adjust to this new, much larger capital structure.
Okay, let's move from the verified events to market chatter, because there are some really tantalizing rumors floating around about strategy.
And this brings us back to that central question. What are they going to do with that 620 million euros? The most compelling speculation is that the money is going to be used to significantly bolster their digital asset holdings, maybe through some big strategic purchases.
And if they double down on digital assets, that's just going to intensify the stock's correlation to the crypto markets.
Yeah.
You're basically buying a tech company plus a volatile crypto fund. It totally shifts the risk profile.
For sure. And beyond the crypto talk, we're hearing chatter about acquisition interest, maybe from global financial firms. There's also ongoing talk about the potential conversion of Class B shares.
Which could cause more dilution if they convert to Class A for liquidity.
Exactly. And of course, the General Counsel retiring fuels speculation about a broader C-suite restructuring. Maybe they'll bring in new people with capital markets expertise to manage all this.
Okay, but before anyone acts on any of this, we have to pause and talk about the primary risk. This is really important.
It is. While the incredible margins and solid asset base sound fantastic, the main undeniable issue right now is one of disclosure. There are no verifiable 2025 SEC filings publicly available for independent review.
And that is the single most important caveat here. All those numbers we just cited, the 1,600% profit margin, the PE of 6.70, they all rely on third-party aggregators and analyst reports.
Given the extraordinary nature of some of these numbers, you must treat this situation with caution until official verifiable filings are released.
So relying solely on analyst consensus, especially with a company that has such wild non-operational income swings, is just dangerous.
It is. Until they publish official numbers confirming the strength of their balance sheet post-capital raise, due diligence dictates a high degree of skepticism.
So factoring all of that in, the stellar but unverified fundamentals, the bullish technicals, the massive capital raise, and the leadership changes. What does this whole complex mix mean for an investor's horizon?
Well, the core business seems to have this extraordinary fundamental strength, and that's coupled with a very bullish technical setup. So the market is optimistic. We see near-term upside driven by, the anticipation of strong Q3 earnings in January and probably new strategic announcements.
So this suggests the stock is attractive for two distinct profiles. First, for short-term momentum, capturing a move ahead of those December and January catalysts. And second, maybe as a long-term core holding. If you believe management can successfully deploy that $620 million at a return rate above 10%.
The immediate future for strategy is all about managing that recent enormous capital injection and integrating new leadership. It presents a complex but highly volatile mix of immense opportunity and significant regulatory risk while we wait for official numbers.
The real test will be how effectively management deploys that massive capital raise. Will they use it to shore up operations, fuel entirely new ventures in the digital asset space, or will it simply be consumed by the high cost of that 10% preferred dividend? That's the question you should be mulling over as you look at strategy's future.